Have you ever heard the saying, "Don't put all your eggs in one basket"? In the world of investing, this old phrase is more relevant than ever.
I guess.
Because one of the most important yet often overlooked principles in building long-term wealth is diversification. In this video, we're going to unpack exactly what a diversified portfolio is, why it's essential for both beginners and seasoned investors, and how you can start creating one today. By the end, you'll not only understand how to reduce your investment risk, but you'll also feel more confident managing your financial future. So, what is a diversified portfolio? At its core, it means spreading your investments across different types of assets, so that no single investment has the power to damage your overall wealth. Imagine this. If you invest everything into one company's stock, and that company goes bankrupt tomorrow, you could lose everything. But if that one company is just 5% of your entire portfolio, alongside real estate, bonds, index funds, and other assets, the damage would be minimal. That's the power of diversification, protection through balance. Now let's get more technical. Diversification can happen on multiple levels. First, there's asset class diversification. This means having a mix of stocks, bonds, real estate, cash, mutual funds, ETFs, and even commodities like gold or oil. Each asset behaves differently under different market conditions. Stocks might go up in a growing economy, while bonds might hold strong in a recession. Real estate often appreciates over time but can be illiquid. Cash provides stability but low returns. By blending these, you get smoother, more stable returns over time, instead of sharp ups and downs. Next, you have sector diversification. Even if you're only investing in stocks, you want all your stocks to be from the same sector, like tech or energy. For example, if you had only tech stocks in early 2022, your portfolio likely took a major hit. But if you also held stocks in healthcare, consumer goods, and utilities, those could have balanced out your losses. Sectors rise and fall at different times depending on economic trends, government policies, and consumer behavior. Diversifying across them gives you more resilience. Then there's geographic diversification. Most beginners invest only in their home country, which is natural, but that limits your exposure to global growth. For example, US stocks are powerful, but emerging markets in Asia, Latin America, or Europe may offer higher growth at times. Companies in different countries are influenced by different political climates, economic cycles, and currencies. Including international stocks, global ETFs, or foreign mutual funds in your portfolio adds another layer of protection and opportunity. But diversification doesn't stop there. You can also diversify by company size, small cap, mid cap, and large cap stocks. Small companies may offer higher growth potential, but with more risk, while large companies offer stability, but slower growth. A blend gives you both growth potential and safety. And here's where most beginners go wrong. They think holding a bunch of different stocks means they re-diversified. But if all those stocks are from the same sector, say 10 tech stocks, they're likely to move together. True diversification requires mixing not just different stocks, but different kinds of investments that behave differently. That's how you shield your portfolio from large, unexpected losses. Now, let's talk about the benefits. First, and most obvious, risk reduction. When your investments are diversified, you're not putting all your trust in one asset's performance. One asset underperforms, others may compensate. This helps you avoid panic selling during a downturn and gives you peace of mind. Second, more consistent returns. A well-diversified portfolio is less likely to experience massive swings in value. This is crucial for long-term investors, especially if you're replanning for retirement or saving for a home. It's not about getting rich quick. It's about building wealth steadily and safely over time. Third, opportunity for growth across markets. You'll be able to tap into multiple income streams and growth cycles. While one market is slowing down, another might be booming. For instance, real estate might be flat, but tech stocks might be rising. Diversification ensures you're never left out of the action. So how do you build a diversified portfolio as a beginner? Start by defining your investment goals and risk tolerance. Are you investing for retirement, buying a house, or just trying to grow your money slowly? Next, choose a core mix of assets that reflect those goals. For example, 60% stocks, 30% bonds, and 10% cash or alternatives. You can also use ETFs or mutual funds, which are great for instant diversification. A single ETF like the S&P 500 gives you exposure to 500 large U.S. companies, or a total world stock ETF lets you invest globally in one click. Don't forget about rebalancing. Over time, some investments grow faster than others and throw your original mix out of balance. Rebalancing means adjusting your portfolio, usually once or twice a year, to get back to your ideal asset allocation. This helps you stick to your strategy and avoid taking on too much risk. And remember, diversification is not a one-time thing. It's a strategy you apply throughout your investing journey as your goals, income, and the market evolve. So should your portfolio. The key is to stay diversified, stay disciplined, and stay focused on the long game. So, to wrap it all up, a diversified portfolio isn't just a fancy financial concept. It's your shield against market chaos. It's your ticket to consistent growth. And it's your most powerful tool for building long-term wealth. If you take one thing away from this video, let it be this. Investing isn't about gambling on one winner. It's about stacking the odds in your favor, and diversification does exactly that. Thanks for watching. If you found value in this video, please give it a thumbs up, drop your questions in the comments, and subscribe to Mauuak Saving Tips for more helpful guides just like this. Until next time, invest smart and stay diversified.